Welcome to Section 4 of our ASC 323 training series. Today, we tackle 3 scenarios every equity method accountant will face in practice. By the end of this section, you will be able to handle the trickiest situations in equity method accounting. You will know when to stop recognizing losses, when exceptions keep you going, how to resume after a suspension, how to test for impairment, and what to do when ownership levels shift. These are the judgment calls that separate a confident accountant from one who has to guess. Here is the most important guardrail in equity method accounting. Your investment account cannot go negative. As the investee reports losses, you absorb your share, and that reduces the carrying amount on your books. The moment that balance hits zero, you stop. You do not recognize any more losses. You track the suspended amount separately because it will matter later when the investee turns profitable again. Think of zero as a floor. Your exposure ends there unless you have made a specific commitment that extends it further. 2 situations keep you recognizing losses even after the investment hits zero. First, if you have guaranteed any of the investee's obligations to third parties, you are on the hook for those amounts. Second, if you have formally committed to fund additional investee losses, that commitment is a real liability. In both cases, you keep absorbing losses up to the ceiling you created. The key logic is that your economic exposure did not end when the investment balance reached zero. You extended it yourself through a guarantee or a funding commitment. Once you hit that ceiling, you stop again. Walk through this with me. You enter year 3 with $50,000 in the investment account. The investee posts a big loss and your 30% share is $80,000. You recognize $50,000. That takes the investment to zero, and you suspend the remaining $30,000. In year 4, the investee turns a small profit and your share is $12,000. You cannot pick that up yet because the $30,000 of unrecognized losses has not been fully recovered. In year 5, your share of profits is $24,000. Add that to the $12,000 from year 4, and cumulative recovery reaches $36,000, which finally exceeds the $30,000 suspended. You resume the equity method and recognize $6,000. Now let us turn to what happens when the investment itself loses value permanently. Markets go up and down, and investees have good years and bad years. Not every decline in value triggers an impairment write-down, but when a decline is other than temporary, meaning recovery is not reasonably expected in a reasonable period of time, you must act. This is a single-step test, which is simpler than the 2-step model used for property, plant, and equipment under a ASC 360. You assess whether the decline is temporary or something more serious, and if it is more serious, you write the investment down. The judgment call is the word temporary, and the standard gives you specific indicators to evaluate. These 5 indicators are your checklist. No single indicator is automatically decisive. You weigh them together. Sustained losses over multiple years are a strong signal. A fair value that has been well below carrying amount for a long time is another. If the investee is struggling financially, facing going concern doubts, or if you expect to sell the investment at a loss in the near term, those all point toward other than temporary. The more of these that apply simultaneously, the harder it is to argue that a recovery is reasonably expected. Once you conclude the impairment is other than temporary, the measurement step is straightforward. Once you have concluded the impairment is other than temporary, the math is simple. Subtract fair value from carrying amount, and that difference is your impairment loss. You debit impairment loss and credit the investment account. The new fair value becomes the carrying amount going forward, your new cost basis. One critical rule: you cannot reverse this write-down later, even if the investee's fortunes improve. That no-reversal rule is a hard stop under U.S. GAAP. With impairment covered, let us move to the scenarios where your ownership percentage itself changes. When you buy enough additional shares to gain a controlling interest, the accounting changes fundamentally. You stop using the equity method and start consolidating. But before you do, you remeasure your existing stake to fair value as of the acquisition date. If fair value is above your carrying amount, you recognize a gain. If it is below, you recognize a loss. This remeasurement step marks a clean break between the equity method period and the consolidation period. From that date forward, you pull in 100% of the investee's assets, liabilities, revenues, and expenses. Ownership can also move the other direction. If you sell enough shares to lose significant influence, you stop the equity method and keep whatever carrying amount remains as your new cost basis under a SC 321. If you sell only some shares but retain significant influence, you recognize a proportionate gain or loss on the shares sold and continue the equity method on what remains. A third scenario is dilution, when the investee itself issues new shares and your percentage shrinks even though you did not sell anything. In that case, you still recognize a gain or loss in earnings for the dilutive effect on your stake. Next, let us formalize what discontinuing the equity method looks like step by step. When significant influence disappears, you make a clean cut. Stop picking up the investee's earnings or losses on the date it happens, not at year-end, not at the next reporting date right then. The carrying amount on that date becomes your new cost basis going forward. You then apply a SC 321 from that point forward. One rule that trips people up: no retroactive restatement. Prior periods stay as reported. The equity method simply ends prospectively. That clean cutoff keeps the financial statements consistent and avoids reopening previously issued periods. Let us bring this section together. The zero-floor rule protects you from recognizing losses beyond your true exposure, unless you created additional exposure through a guarantee or commitment. Resumption after suspension requires patience. You must recover all suspended losses through profit shares before you can start picking up income again. Impairment under the single-step OTTI model is a one-way write-down to fair value. Ownership changes each have a specific accounting response, from remeasuring to fair value when you gain control to retaining carrying amount when you lose significant influence. Thank you for completing this section on losses, impairment, and ownership changes. Thank you for watching. Subscribe for more training from PNJ Group.